Good afternoon, ladies and gentlemen. I am Seema, moderator for this conference. Welcome to the conference call of Aptus Value Housing Finance India Limited, arranged by Concept Investor Relations to discuss its results for the first quarter ended June 30th, 2022. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. At this moment, all participants in the line are in listen-only mode. Later, we will conduct the question and answer session. At that time, if you have a question, please press star and 1 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference call to the management. Thank you, and over to you, sir.
Yeah, thank you, Seema. Ladies and gentlemen, good afternoon to all of you. I am Anandan, Chairman and Managing Director of the company. I welcome you all to the conference call to discuss the financial performance for the first quarter of the financial year FY23. I have with me Mr. G. Subramaniam, ED, Head of Business and Risk, and Mr. P. Balaji, ED and CFO. The results and the investor presentations are available on the stock exchanges as well as our website, company website. I hope everyone had a chance to look at it. Aptus had healthy first quarter, which is reflected in our strong financial results. Disbursements growth picked up momentum and collections are back to pre-COVID levels. With the focused collection efforts, our 30+ DPD sharply improved to 6.48% in June 22 versus 9.91 in March 22, and earlier it was even 12.98 in December 21. However, there is some inch up however, some forward flow into the stage 3 assets has resulted in our GNP going up slightly higher marginally, which we'll cover in detail later. The total disbursement stood at 525 crores in for the quarter, first quarter, compared to current year, compared to 247 crores first quarter last year, up by 113%. AUM as on June 22 was at 5,519 crores, which represented a healthy growth of about 30% year on year. NIM for the year was at 14.28, representing an improvement of 181 basis points compared to Q1 FY22. We have registered an ROA of 8.88%, which, as you know, is one of the best in the industry, and an ROE of 15.89%. I would like to reiterate the fact, as I did in our earlier call, that we have enough on-balance sheet liquidity. Currently, we are carrying about 1,300 crores of liquidity, including the undrawn sanction from banks to the extent of 575 crores. Our net worth stands little over 3,000 crores, which indicates robust capital adequacy in order to support our future growth. Key highlights of Q1 23 performance being NII was at about 195 crores, up by 49% YOY, and NIM 14.28%, up by 181 basis points YOY. Our net profit at 119 crores, 62% higher than previous quarter, and AUM at 5,519 crores, a growth of about 30%. And disbursement for the Q1 FY23 was at 527 crores, a growth of 113%. And our GNPA was slightly higher at about 1.78%. Of course, this is based on the revised RBI guidelines. Capital adequacy is very comfortable at over 80%. Our ROA, as I mentioned, is about 8.8%, and ROE is one of the highest at 15.89, in comparable companies. I would now hand over the line to Mr. P. Balaji, ED and CFO, to discuss various business parameters. Thank you.
Thank you, sir. Good evening to all of you. As on 30th June 2022, the total live customers crossed 89,000, registering a growth of 31% year-on-year. The total number of branches as of 30th June was at 211. We have added 3 branches in Q1 FY23. Employee count was at 2,410. Major performance highlights are AUM grew by 30% year-on-year to 5,519 crores. Disbursements increased 113% year-on-year to 525 crores. NIM was at 14.28%, increased by 1.81%. OPEX to assets were at 2.44%. There was a 34% reduction as compared to the corresponding quarter. PAT was at 119 crores, 62% growth year-on-year. ROA and ROE was at 8.88% and 15.89%. Now coming to the asset quality. With focused collection efforts, 30 plus DPD sharply improved to 6.48% in June 2022, as against 9.1% in March and 12.98% in December 21. There was some forward flow into stage 3 assets, which we are cognizant of, and we will be bringing it down in the ensuing quarters. And because of that, we have also increased the ECL coverage, and because we have taken a debit in the P&L account to the extent of 9.5 crores. And GNPA, as per the revised RBI guidelines, were at 1.75%. Net NPA was at 1.32%. Provision coverage increased to 0.92% as on 30th June from 0.8% in March. We are carrying a total provision of 51 crores, and this, when computed as a percentage of the NPA, works out to the coverage of 53%. Outstanding restructuring book were at a nominal 1%, and the behavior of this book is on par with our normal book. We have well-diversified borrowings. Out of the total borrowing, 52% were from banks, 28% were from NHB, 14% were from DFIs like IFC and large financial institutions, and the balance is in the form of securitization. During the quarter, our rating was upgraded to AA- by CARE, and ICRA has already upgraded us to AA-. This will help us in exploring more sources of funding and also help in reducing the cost of funds. We had sufficient on-balance sheet liquidity of 1,300 crores, including the undrawn sanction of 575 crores from banks. As on 30th June, our net worth was over 3,000 crores. Now, with this remarks, I open the floor for the question and answer session. Thank you for listening.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. First question from the line of Mona Ketan from Dolat Capital. Please go ahead.
Yeah, hi sir, good evening. And congratulations on a good set of numbers. Firstly, on this 30 plus DPD, which has improved over the last 2 quarters, what is the scope of further improvement here, and where would it probably settle at? What could be the steady state level?
Yes. See, we have been reducing this for about last 2 quarters, as you are seeing from the figures. There will be small reduction from this level
and at that point, I think it will stabilize. It will not further reduce very steeply from that.
Sure, got it. And where would our 1+ DPD stand at currently?
Actually, our 1+, it is actually 1+, that is 30 days over, it is close a little less than 10%. That comprising of,
1 to 30 days.
0 to 30. Actually, 0 to 30 is less than 10%.
Okay.
Mona, I'll explain. See, 0+ is standing at little less than 9%. 30+ is standing at around 6.48%.
Yeah, right.
And greater than 90 is standing at around 1.75%.
Sure, got it. And
You see, it used to be at 9.91. It has come down to 6.48. Further, it can come down, say, 5 like that.
Actually, our 90 plus at 1.7 as per the revised guidelines, and 60 to 90, which is less than about less than 1%, about 0.78%. So in other words, if you look at 60 plus, it is only about 2.3, 2.4% only. And 30 to 60 is the number which Balaji gave, that 6%. Adding up to 30 plus is a little less than 10% kind of thing. Going forward, we do expect, while there could be marginal, there will be reduction in the NP of 90 plus from the 1.75 to come down further, but 60 to 90, there may not be much of reduction because it's already at 0.7, 0.8. But there will be, we are expecting through better collection, some reduction in 0 to, 31 to 60, the 6% there will be a scope for reduction. And 0 to 30 also there will be some scope for reduction. But the point is that we will be moving closer to almost about 94, 95% of our portfolio with nil overdues.
Sure, got it. And okay, moving on to the next question. When we look at your small business loan and quasi-HL products, is there a case of compression in yields here as you expand into newer geography and competition intensifies?
Because the volatility and the quality of business will be different in the small the SME business kind of thing compared to the home loans. If we start looking at in terms of our logging in, decline, approval, disbursements, and also in terms of our in terms of the check bounce, collections, NPA and all, far better and coming much better than what we have initially expected. But in case of SME, there is still some lag in terms of impact of COVID, and that's why if you really look at even in the first quarter, while overall disbursement growth is about 113%, the growth in the SME business is less, slightly lesser, and it was a conscious decision to really do only quality business and not really be after the volume disbursement. But we are, in our segment, we do realize it's a very large segment, profitable, and also from the ALM point of view, also very, very good for us. So given that, the overall there will be, the market size is large, and overall there will be a growth, coming in the future as well. So when we are looking at the company level growth of 25-30%, we would expect the same kind of growth to come from the SME business segment also going forward.
Further to that, Mona, just one point, the yield which we are charging, which is at 21%, But we are not intending to change because that itself is low as compared to our peers like maybe 5-star or Veritas or whoever is charging 24% or 26% or even Sriram. So we are charging a rate which is related to the market, and we will not reduce those rates.
Sure. And on the cost of funds, I mean, you had earlier guided for the reduction of 25 to 50 bits in this fiscal versus last fiscal. Do you sort of maintain that guidance given that, policy rates have risen by 140 bits so far?
Yes, it is a fact that RBI is aggressive on the interest rate hike. If you look at our June performance, the 7.74% which was in March has got reduced to 7.68%.
Right.
This is because of the rating upgrade where we were able to renegotiate rates with the existing lenders, and also we were able to get funds at around 7.4% to 7.5%. And during the quarter, whatever we raised, at least 50% or more than 50% were in the form of fixed rate interest. So to that extent, it is going to be either it can be at this rate, or that in this quarter there will be energy funding which will be coming, where the interest rate will be less than the cost of funds from the banks. So to that extent, there will be reduction in the cost of funds, and that's what we are hoping for.
So you sort of maintain that 25 to 50 bits reduction guidance for this fiscal?
25 basis points is for sure, yes.
Okay, sure. And just finally, of this 1.75% of stage 3, how much would be the impact from RBI circular?
1.28.
1.28 is the without RBI circular, and 1.75 is with the RBI circular.
Sure. Thank you so much. I'll come back in the queue if there's anything.
Thanks.
Thank you very much. We take the next question from the line of Nidesh from Investec. Please go ahead, sir.
Thanks for the opportunity, sir. So my question is on how should we think about the profitability of the business in the context that there are three stakeholders, shareholder, customer, and employees, and 8% ROAs look very, very high. So how should we think about balancing the overall economics between customer, shareholder, and employees? It seems like at this point in time, shareholders are making much higher profitability, while our cost of operations are one of the lowest among housing finance companies, and we are also charging much higher yields to our customers. So shouldn't it will be a good strategy to pass on some benefit to customer, pass on some benefit to employees, and make the business model much more scalable with, let's say, at a 4-5% ROA? How should we think about that, sir, internally?
So basically, we don't believe in the philosophy of compromising on our ROA to the extent of 4-5% and things like that. And we are very confident of maintaining our existing ROA. Obviously, with the leverage improving, that 8.8% will come down maybe by another point or two. But we are very confident of maintaining an ROA of at least 7%. Again, the point, one issue that we keep coming across with all concern is that our ROA is very high. Again, this very high comment is being made in comparison with some of our competitors. And we have also seen the data of almost about 5-6 leading competitors operating the same line of business. First of all, our product segments are different. And second is, in terms of we have the SME business, whereas they don't have, some of them. So in other words, our ROA is high. Even if you look at just from the sales realization, the first level sales realization itself is the see, it is almost about 3.5 to 4% higher, primarily because of the product mix, comprising of the SME and the home loan segment. And we expect both the home loans and SME, we are only in the beginning, and a lot more markets to be covered, and this growth rate and these lending rates, we can be sustained. as Balaji has mentioned a little while ago, that for example, in case of SMEs, we charge 21%. That is what being charged by almost every, NBFC. Not only NBFC, even if you take the effective interest rates of some of the leading gold loan companies, they are charging 21% plus. So in other words, in same way in terms of our home loans or quasi home loans. So we don't really see any significant need for us to maintain our targeted growth rate of about 25-30% year for the next 5 years. We don't really see any need to really look for any substantial reduction in our ROA. ROA again, apart from the sales realization, every line, whether it is the operating expenses, whether it is our productivity, whether it is our even the credit cards. In fact, the last two periods, we have charged a credit cost of closer to about 15%. 1.5%. 1.5%. Of that, only 0.12% is really actual write-off. The rest is really an enabling provision. That is what I mean by 0.75 that we have debited this quarter, and previous year some 0.85. Both put together, if you really see, our actual bad debt write-off is only about 0.12. The balance really, 50 crores is just an enabling provision, implying our quality of portfolio, is good. So in other words, our product mix, sales realization, our OpEx continues to be, one of the, best in the industry. In fact, we find very interestingly our OpEx, there are two things. One is our OpEx being less. Second thing, others OpEx being very, very high, very high. So we have really make a line-by-line comparison of the number of employees, employment costs, branches, branch office costs, transaction costs, courier costs, printing costs. Every cost we line by line we have compared, and some of the competitors, that cost structure is higher for good reason known to them. So in other words, we really see Aptus as a very cost-efficient organization, productivity-oriented organization, and we do believe that we will be able to sustain, but for the reduction that could happen because of the higher leverage, which obviously will result in better ROE. We don't really see any significant reduction in our ROA per se. And we also realize by reducing a lending rate by another 50 basis points, we are not confident that our growth rate will go up by another 5 basis points more, 10 basis points more. Because it's, the pricing power of this segment is different in the sense that, whether we increase it by another 25 basis points or reduce, and it doesn't really result in higher business. Higher business will result in terms of through more branches, more staff, better productivity of the existing staff, better productivity of branches staff, better underwriting practices resulting in, reducing decline and things like that, and better recovery. So in other words, to answer your question in terms of that, we don't really see there is any substantial, any specific need for us to reduce the ROA through the, through reduction in the lower lending rates.
Sure. And second, sir, can you share the BT out rate in the housing finance, just in the housing finance book for the quarter?
Yeah, our BT, actually our pre-closure itself is about 8.62%. Out of that, 77% comes out of own source. So the 23% of 8.62, it is about roughly about 2% comes as a BT.
Sure. So 2% is the annualized BT rate, annualized only for the housing loan book, right?
Yes.
Basically because our presence, as largely in Tier 3, Tier 4 cities, with an average loan of about 7 lakhs, 8 lakhs, 9 lakhs, and the average EMI is about 12,000 rupees. These customers, some of our competitors, particularly the banks and larger HFCs, they are not too keen to, particularly to the self-employed customers living in Tier 3, Tier 4 cities, to do a loan of about 8 lakhs, 9 lakhs. They don't want to be spending time, travel, and underwriting costs, transaction costs, resulting in that, they would rather look for opportunity to, assignment or the securitization rather than come try to take over a customer from us. Because for them, that's what we find that the real motivation, even for the customers, for them to really walk over, we don't see much of it. So even though it is as 8%, as we have said, closer to 6% is really, they are closing it out of their own money. Only 2.5% is a loan transfer going to the other HFC banks. And they've been happening consistently last 6 years, and including in the first quarter of this year.
So the line of the participant has got disconnected.
Yeah,
I'll move the next question. Is from the line of Manoj Oberoi from ES Securities. Please go ahead, sir.
Yeah, sir. Hi, this is Rajiv here. Sir, if you can, this significant movement between, buckets. So we had a very sharp reduction in 30 to 90 bucket, and then you had significant flow back as well as you had significant flow forward into 90 plus. And when I were to look at our portfolio, which is highly concentrated in certain geographies of South, so why did we have this kind of differentiated movement? Because it's a pretty significant movement both ways in one quarter. And because we had certain customers under stress, whereas we had certain customers improving their cash flows, despite we operating in a concentrated geography.
Actually, prior to COVID, our nil overdues are always over 95%. We never, literally 0 plus, or 30 plus, 60 plus, 90, all, it is not even 5%. It's much lower than 5%. Till COVID for about almost 8-9 years, and we had a zero write-off. But then COVID came, and because of COVID, we had to really, first COVID 1, COVID 2, we had to go for restructuring or the moratorium. And we have taken a conscious call at that point in time, particularly in COVID 1. We would, instead of really going for a very liberal approach on the restructuring and the moratorium, we would really, give, only where absolutely required where the customer insisting wanting the moratorium. And to the extent our, restructuring and moratorium was one of the lowest in the industry. That has resulted in our soft bucket outstanding really going up because the COVID 2, which was not expected, came in, and B, in terms of, while the customers are really paying one EMI every month, for them to clear the second EMI was taking time. And that's why while our NPA has not greatly, significantly moved, but there was a substantial increase in our soft bucket. And this is what we have been sort of in the last 1 year or so, leading every quarter, there is a progressive reduction. In fact, at some point in time, if you look at our past data, we have the soft bucket outstanding of closer to about 20%. Then it came down to, 15, 12, 9, now 6 and all. Because it's nothing but the additional effort being put to, prevail the customers to collect the second installment. I think we are hopeful of moving the same direction and try to get back to our pre-COVID level of nil overdues of around 95% of the earliest opportunity.
Okay. And was there any concentration of geography or regions in the accounts which flowed forward?
No. See, sorry, in NPA?
Yeah.
Yeah. Basically, the more than concentration, the repayment culture of certain PIN codes, certain areas, certain states, so slightly different. In other words, the same outstanding we got it on a PIN code wise basis, state wise basis, namely Tamil Nadu, Andhra, Telangana, Karnataka. There are differences. That's why possibly we would say that our best portfolio may be in Andhra and Telangana, Tamil Nadu and Karnataka in that order. And that's how we have organized in terms of our recovery effort also.
And sir, a few clarifications. The currently out of 1.75% NPLs, you spoke about less than 90 DPD NPLs, which are around 1.28%. Would that be right?
Yes. No.
Okay.
The NPA calculated as per the old methodology is 1.28. So 1.28 minus 1.75 will be the
0.47. Difference.
Got it. And currently the 1 plus number is around 9%, right?
Yeah. Yes.
Okay, which in a normal course over a period of time we should be at around 5%, which you said 95% regularly paying customers.
Yes. Right. This was around 11% in March. We got reduced to 9%. Yeah.
Right. And you also spoke about NHB sanction coming in this quarter. What will be the quantum of that NHB sanction?
No, I don't not speculate. But now, let us put it this way. We've been getting an excellent support from the NHB, and already our of the loans that we have got, 26%? 28% from NHB. And the last loan that we got from NHB is for about 300 crores, if I recall, and at a very good interest rate of 5.8% for the full tenor of 10 years. So, and our NHB, they've been having yearly, touch with their audit also. They both on the portfolio side and the regulatory side, they are quite happy. So to that extent, we do expect a reasonably good size loan, but how much of it one has to wait and see.
Yeah, and sir, what will be a current assessment that if...
Mr. Manoj, may we request you to please return back to the question queue? There are participants waiting for their turn.
No issues. Thank you.
Thank you very much. We take the next question from the line of Amit Bhatt from MIT. Please go ahead, sir.
Hi, Amit here. Good evening. Sir, how historically company performing in raising interest rate cycle? And are you confident to give 30% top line growth with the same net interest margin in this interest rate scenario?
You see, the question is that like the last 10, 11 years, I mean, that may not be an indication for certainty into the future, but last 11 years, we have hardly revised our interest rate. Across the interest rate cycles, we have by and large maintained the same. I think only once we made some marginal corrections. Barring that, see, even current year so far, we have not revised any interest rate. And we've tried to really absorb whatever little interest rates, because again, it so happened of our 6,000 crores AUM today, our balance sheet size, about 3,000 crores net worth, and the balance 3,000 crores approximately is the borrowing. And of that cash, if you take it out, actual borrowing is about 2,400, 2,500. Again, that 60% of the 2,400 is fixed rate for another 5 years, 7 years. It is not linked to any MCLR, PCLR and all. So in other words, the impact of this interest increase is also possible if at all it comes with some subsequent years rather than current year or the next year, because of the high content of long-term fixed loan with no variability clause on the interest rate. So of our loans, somewhere in the presentation, I think there is a slide to say that over 66%, almost two-thirds, is really fixed interest rate, and actually it is 62% fixed and about 38% is only variable. So given that, and the other good thing is that since the company credit rating we got upgraded in December 21, that gave an opportunity for us to re-engage with some of the bankers to really fine-tune their lending rates. And that has also helped us to absorb the increase in the interest rates, wherever it is happening to an extent. So, by and large, again, the question is that at least not only for us, by and large for generally affordable housing companies, there is certain amount of pricing power is there. It is not like the matured large companies where the pricing power is zero. So our pricing power, even if revised by another 20 basis points, or 50 basis points, 12,000 rupees EMI will go up to maybe about 12,200 rupees, 1,200 rupees. And because the loan size is small and the EMI is small and the customers are, we have not gone for an increase, but we don't really see any negative reaction of the customers.
Okay, sir. And to maintain this 30% top line growth, is it necessary to increase branch aggressively?
No, first of all, the top line is not 20%. We are really trying for much more than 30%, at least about AUM level 25 to 30%, and the profit level at least 25% plus. So, we are getting it in any case, despite, in the different economic cycles that have been happening in the last 10 years, including the last 2 to 3 years on account of COVID. So, we will maintain that, growth. At the same time, we will maintain our financial ratios also, metrics also.
Further to that, see what happened is, we have got around 211 branches, of which 149 branches is more than 3 years old, and they are having a average book of 32 crores. The number of branches which is in the range of 1 to 3 years old is 44, and the average loan book is 14 crores, which means that this has the scope to grow up to 32 crores. And less than 1 year branch, which is having an average book of 3, is almost 18. So this again has the scope to grow first to 14 crores and then to 32 crores. With the market being large, we are hopeful that we'll be able to capitalize on this situation and make these branches do well, rather than opening new branches. When we are opening a new branches, we concentrate on productivity and then we demand productivity from the branches. So that is how the whole thing is.
I think, sorry, I missed that point. See, basically, as Bhargav said, we don't believe in the philosophy of let's go and open 200 branches, 300 branches in the next 2 to 3 years, because the business is so good. Let's go by 20% growth rate, look for a 50% growth rate, and go and open the branches. We don't believe in that philosophy. We are very conscious of adding, growing really progressively, and at best we will add about 20 to maximum 25 branches in a year, not more than that. And these also will be, first option will be within the existing states, and the second option will be in the states which are contiguously located. And all the time we will look for this growth coming through the prudent branch expansion, and same time increasing the productivity, people-oriented productivity, and branches-oriented productivity. In fact, even the current year growth will largely come out of 18 branches which are added in the last 1 year. The loan book is only 3 crores. It can easily go up to 30-40 crores. And then, the last 1 to 3 years, we've got 44 branches added. We would want the volumes to come out of it. So, in other words, we will keep adding these 20-25 branches to really more as a working process for the future growth rather than for the current year growth. In fact, without any branch itself, we can get that whatever current growth that we have planned for. Yeah. And if at all we add another 20 branches this year, it will be really for the growth in the next year and the year after. But that does not mean because, everything looks rosy, so why 20 branches, why not 100 branches? That philosophy we are not in. because it creates a lot of other related issues in terms of underwriting quality, collection, productivity, and also there is a significant constraint in this business in terms of the HR. In fact, it is not only the branches that matter, it is the quality staff at the branches really one of the critical needs. If the companies are not able to really match the quality staff in all the new branches, then growth will not come. Because I've come across a company where they have 6,000 and odd staff, published data, and with only twice of our loan book, our number of staff is 2,400. And their branch is about 340 with about 6,000 staff. Our branch is 211 with about 2,400. I would rather look for more productivity and better control rather than keep adding more branches and indiscriminately adding more staff.
Hello, sir. And lock-in period for some of the pre-IPO investors is now ending. That is a report from the CNBC. So this lock-in period, because 6,000, 7,000, they are claiming 6,000, 7,000 crores rupees of stocks are going to come to the market. So already the price is below the IPO price. So how you are thinking that these people are going to be, the institutions are behave in that scenario?
Yeah, I do not know the basis of the 6,000, 7,000 crores. I don't have the calculations ready with me now. But, the end of the day, as a company, we are really focusing on how to improve the performance, quality of the performance, quality of our loan book, and communicate it and share it with all the key stakeholders. And that's what our primary job is going to be. And that's where, for example, even the first quarter of this year, our results are one of the best, in the affordable housing finance segments compared with anybody else. So we would really keep working on, how to improve the company performance, company's growth, company's financial metrics better. And we will leave the market price valuation in and day out, to the market really. We don't have much control, as you know.
Thank you very much, sir. Thank you very much. Appreciate it.
Thank you, sir. We take the next question from the line of Ankit Bansal, individual investor. Please go ahead, sir.
Hello.
Yeah, Ankit.
Sir, my question is, with the increasing your domain, like you are expanding in Odisha, Maharashtra, sir, how are customers able to know your model better, like other NBFCs are there? How are they attracted to your company? What are your model so that more and more customers are attracted? So that is my question.
See, basically, if you really see the origin of this company, being headquartered in Chennai, we commenced our operations first in Tamil Nadu only. And then progressively, we have added Andhra Pradesh, Telangana, Karnataka. And when we added them, they are new markets to us, new customers to us, and new process to us. But then we have demonstrated a very high level of capability. Though it is broadly, called South, but the culture of each of these states are different. The culture of Telangana is different, the culture of Karnataka is different, so is the Andhra and Tamil Nadu. So, so we have a demonstrated, proven experience of last 10 years in terms of, when we enter a market, particularly for the affordable housing finance that we are in, we do a lot of homework. We do extensive homework in terms of our own capabilities, our own branches, our own staff, experience, processes, and the market potential, including studying the PIN code wise, market behavior, payment culture, and a lot of things. And we commence the business very progressively only we build. For example, Orissa we commence, we just added one branch about 4 months back. We have not added about 10 branches there. Well, we would really want to study, and only we'll add our second branch, third branch, fourth branch. We will take our time. So that is really, also we've got a tool called early default analysis. Whenever we do business in a new market, new segment, new geographies, new branches, we track them for the first 15 to 18 months, what we call early default analysis. And we track them in terms of how many proposals we have done in that area, new area, and what is the prepayment practices like, and what are the gaps, if any, in the underwriting, collection, and things like that, and the training needs of the local branch staff, and keep fine-tuning them. Then only we will start expanding. So, this is something which we have done it in the 4 states, which we are hopeful of extending it progressively over time in the other 2-3 adjacent states that you have just now mentioned.
Just to add, we also study the market so that we fix our model, the self-construction model. We will not go to area where there is no self-construction. And also, the customers normally are attracted to any company because of the transparent process, the speed in which they do the transactions, and they feel that, okay, this company is good. So these are the things which helps Aptus to attract new customers and also retain the customers.
Okay. Sir, my next is, sir, what are your future plans for expanding like multi-floor, like exponentially? What are future plans for 2 years, 5 years, so that of growing your business exponentially?
Very, very simple. We don't have any plan to explode growth, to grow exponentially and all. No. Our philosophy is that grow consistently, pursue a consistent growth, quality-oriented growth, and profitable growth, risk return which takes into consideration the risk involved in the business, and so we will progress, and we are very highly focused. We are absolutely laser focused. We will do only this and nothing else. We will not get into any unrelated businesses, corporate, builder, related party transactions, special purpose vehicles, all those things we are not. We will only be in in this affordable housing, retail, with a singular loan not more than 25 lakhs of rupees. In fact, half our loans of 80 and 1,000 today, not even 1% is of 25 lakhs. To really see the 15 lakhs and below, that will be over 90%. So our so it's a really granular retail home loans for self-occupation largely, and in tier 2 cities with customers who doesn't have any readily verifiable credit history. Because of that, they are not being serviced well, and that's our trump card. And we would want to really, there are very good customers in this segment, but only thing, they have to be identified through our underwriting process, the right collection process, and try to channel the institutional funds to these customers who will otherwise borrow from the local financiers or smaller housing companies. So, but we find that real need for home loans are really here. It is really in the lower and middle income segment of the population. Both on the supply side and the financing side, the real need for homes and home loans are there. And we are happy to be in this segment. We continue to grow in this segment. Our growth may be around 25-30%, but it will be a profitable growth for all concerned.
Okay. Sir, what are your targets for net NPN and GNPA?
Yes.
Yeah. Oh, sorry, can you repeat?
Sorry, what are your targets for net NPA and GNPA for FY23?
The gross NPA about 1.3, 1.4. That is 1.3 is the figure which we are looking at, and net NPA will be a corresponding of the 1.3 gross NPA.
How much?
Sir, I am asking what are your targets for whole year now, FY23?
I have told the whole thing. I have told the same thing.
Yeah, as of now, the GNPA is 1.75. You said for the year, we are working towards about 1.2, 1.3.
So the net NPA will be around 0.9%.
See, also, we have taken a view in the last, FY20, our finalizing accounts for FY22, that, of our 90, anything over 90, anything over 24 months, we write off fully or provide 100%. So in other words, even our NPA of over 90, not even one account will have outstanding of, one account will be there beyond 24 months. In fact, for the first quarter, there are 3 accounts which came, beyond 24 months. They have fully provided for them, and we debited and paid our account. Of course, the actual recovery, legal recovery, third-party recovery, and all will continue. In fact, of the accounts that we wrote off, we have really got about 10 accounts recovered in this period, but what we have to write off is only about 3 accounts. So in other words, apart from the provision, ECL and things like that, we also now have this philosophy of not to have anything beyond 24 months in the books. We'll provide for it or write off 100%, or while recovery actions continue, because at the end of the day, it is secured loan, and we have the property documents. Our name is there in the documents.
Okay, thank you, sir. Thank you very much.
Thank you very much. The next question is from the line of Alpesh from IIFL Securities. Please go ahead, sir.
Congress for the set of numbers. Just 2 questions. First, when I see your OPEX to average loan, that has been trending.
We are not able to hear you properly.
Can you hear me now?
Slightly better, but you can continue.
Sure. So, the Congress on the good set of numbers. The first question is on the OPEX to average loan. That number is coming down continuously every quarter. Where do you see that stabilizing? And secondly, any color on the seasonality of the disbursement? Do we have a stronger second half versus that of first half, depending upon the geographies that we operate? Thank you.
OPEX is currently at 2.44, and to be frank, we don't have much room for that from here to reduce. I think it will either be at 2.4 or maybe it will be maintained between 2.5 to 2.6% with the expansions that is being planned. And having said that, this will settle down at this level. And what was your next question, Alpesh?
The second question is on the seasonality of the disbursement. Do we have a second half? Because we have a very limited data on the quarterly basis, considering some blessing. So I wanted to understand the seasonality of the disbursement, whether the second half is stronger than the first half, depending upon.
Usually, yes.
Seasonality normally first quarter is slightly subdued, but we have a good second quarter, the third month of the second quarter. The third quarter is really good, and then it peaks in the fourth quarter. This is how the disbursements have happened in the last 10 years, and we foresee the same thing to continue this year also.
No, but for a change this year, there is our first quarter volumes are last year.
Yeah, that is a good news. Normally, first quarter volumes are less than the fourth quarter, but we broke the zinc this time. The first quarter volume is more than the fourth quarter.
Actually, I would say, yeah.
Okay, great. Thank you and all this.
Thanks.
Thank you. Ladies and gentlemen, that was the last question for the day. I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Yeah. Thank you. Thank you, Seema, and thank you, Sundan, for organizing this conference call. I would like to pay my sincere gratitude to all analysts and investor friends who have taken time out of their busy schedule to listen to us today. Please feel free to contact us in case you have any further queries. We would be happy to get back to you. Thank you.
Thank you. Thank you.
Thank you.
Nice to
Thank you all of you for being a part of the conference. If you need any further information or clarification, please email balaji.p@aptusindia.com, sanin.p@aptusindia.com. Ladies and gentlemen, this concludes your conference for today. Thank you for using Chorus Call conferencing services. You may now disconnect your lines. Thank you and have a pleasant day. On behalf of Concept Investor Relations and Aptus Value Housing Finance India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line, ladies and gentlemen.
Thank you, Seema.
Thank you.
Thank you very much, sir.